Hey, good morning. This is Mayor Valensky with Driving Markets. I hope you're all well. Quick caveat, anything said in this piece is only an opinion only. It's for media publication. It's not advice, not financial advice, not investment advisor. So let's kick off. So yesterday, for the fourth day running consecutively, the markets were down. They did try to go up in the morning, and then I issued a sell note as an opinion, of course, during the day that the markets can't hold on to their gains, and the markets went down, and then they went back up, and then they went back down. So the markets clearly cannot hold on to their gains, which is not a good sign for the bulls, simply because that a market that can't hold on to the gains shows that there's not sufficient substance there, and the foundations of the gain are not strong enough in order to maintain the hold. So therefore it's a sign to sell. So the general advice is, and this is my very strong opinion, that we're going into a severe bear market. So any rally, you should be selling into the rally. That's quite simply it. What you've got is the rises and falls within the market. However, the overall trend, as I've said over and over again, is down. And if the trend overall is down, then you've got to sell into any rally that happens, and that's what's happened since June. Since June, there's been a bear rally whereby the markets go up within a bear market, and they moved above the 50-day moving average. But that 50-day moving average now is about to be breached, if it's not already breached, and that is a bear sign for those traders trading equities and trading indices. Again, when I say a bear market, I'm talking about equities and indices, not on Forex. That is a completely separate market. We'll touch on that very, very shortly. So yesterday there was a big mover in the US, Snap. Now, Snap or Snapchat was the big exciting stock of a few years ago, and it got valuation on day one of 20 billion upwards. Now, Snap is going in the wrong direction, and Snap is not going to succeed in making itself successful again. It's had over an 80% drop this year, and in my opinion is likely to go bust. Yesterday it went up 9% because of the reorganization of the actual corporate structure, and also they're cutting back on 20% of their jobs. They're going to be cutting back on expenses and cutting back on costs. However, the direction of Snap is not good, and I would say that Snap generally is a sell, as a lot of stocks are within the Nasdaq. Now, what you've got to also follow on from that, you've got Meta. Facebook took a boost from Snap's decision, and investors and traders bought into Meta on the basis that they might do a restructuring. But Meta, Facebook, I'm a big bear of, and I've been calling Facebook down to around about $100 a share. It just so happens I don't like Mark Zuckerberg, so anything regarding Facebook, in any case, I have a negative approach. Take that into account if you're trading Facebook, but I generally don't like Facebook, and I think the overall model across the board for Snapchat and for Facebook and for other media moguls and media giants is based on advertising revenue. Now, the advertising revenue has contracted since the beginning of the year, so there's less revenue going around the same number of players. So obviously corporate earnings are going to be affected or impacted by that reduced availability of revenue within the sphere of those media companies like Snapchat, like Facebook, like Twitter, etc., etc. Talking about Twitter, unless Elon Musk does take it over, Twitter's also going to go nowhere, because their model for monetizing is very, very weak, and they just got, again, no direction, and those shares are definitely not worth what they're worth. They're probably worth about $15, and I would be a big seller of Twitter as well. Talking about some other factors, you've got oil. Now, oil yesterday, talking about slightly on commodities, oil yesterday dropped significantly on recession fears and also new lockdowns in China. Just developing that particular topic, if there's new lockdowns in China, then the supply chain is going to be frustrated even more, or frustrated again, and that is going to lead further to supply chain inflation. So you've got supply chain inflation and you've got demand inflation. So demand is staying at all-time high simply because you've got full employment, but the main supplier in the world at the moment, global supplier, is coming from China, and again China's going into new lockdowns because of another outburst or outbreak of corona, and that's going to frustrate inflation furthermore. Now, on the basis of that, oil went down, because if we're going to go into a lockdown in China where the demand is going to drop, and therefore there's going to be less demand from China and potentially recession, which is what all the central bankers are talking about, then that has pushed down the demand for oil, and oil came off as a result. I'm still a big buyer of oil, but one of my colleagues said that oil could go down to $80 a barrel before bouncing up again. I'm not sure about that. My opinion is that it's going to hover around these levels, but it is going to try and break through the $100 barrel level. It's just got a lot of undercurrent of demand which you can't get rid of, and it's there, and it's going to bear through into financial markets. Talking about the yield is heavily inverted between the 10-year and the 2-year. So the 2-year yield is higher than the 10-year yield. Talking about the US Treasuries here, and once you've got that is a clear sign or lead indicator of a recession. In fact, that lead indicator has not failed in the last 30 years. So it's a bad sign for economic downturn, and it's a bad sign that we're going to go into recession when the 2-year yield is greater than the 10-year yield. And also in UK gilts, you've also got the 10-year yield has jumped up to over 3%, and that's also having a big impact on markets. The FTSE yesterday was down more than 1% on the back of that. Then you have inflation in the Eurozone came in at 9.1%, higher than expected. I thought it would come in in excess of 10%, and we're going to go into double digits. I want to make it very, very clear on this program, I can see inflation running at 18-20% by this time next year. Goldman Sachs called inflation 22% in the UK next year. I'm calling it between 18 and 20%. It could even be 22%. I think inflation in the States is going to go also to 18-20%, and in Europe. So that's my overall view on inflation. As far as crypto is concerned, Bitcoin is heavily supported at 20,000. It breaks down below it, then bounces up. So there's a bit of a battle going on there on Bitcoin, and in my opinion, can expect it to fall down to around about the 18,000 level to test that, and from there we'll see where it goes. If it's strongly supported again at 18,000, they'll probably bounce up back up to 25. If it breaks below 18,000, it's going down to 13, 14 or 15,000 on the cryptos, on Bitcoin. So I would generally, at these levels, wait and see if it breaks down. If it breaks down, then continue selling. Overall, equity markets just keep on selling into any rally. As far as foreign exchange is concerned, you've got a strong dollar. I would be a buyer of dollar yen. The yen is weak, the dollar is strong. Euro dollar is going to go below 96 to the dollar, which is below par, and the pound, unfortunately, which I'm a big supporter of, is probably going to float down to the 113, 114 level before it bounces. When it does bounce, it's going to bounce aggressively. This is Mayor Valensky with Driving Markets. Have a good day.